Master, open interest and liquidity is ready at your command.
Buy up the market.
No, don't do it! No!
How did you do that, master?
A really great market maker. What he does is he smells the fear in the market. And what he does is he organizes himself to be able to take advantage of other fears. Ultimately he is disciplined and has developed a strategy and intuition to be able to see the supply and demand, and he knows the blood there and he knows where they're trapped. Then he takes the liquidity.
That's amazing, teach me.
He will show you.
In this video, you will learn what supply and demand is, why it's important, and how you can utilize it to become a better trader. This will be broken down over these sections: fundamentals of supply and demand, identifying supply and demand zones, drawing supply and demand zones, zone patterns, what the best trading strategy is, and trade setups covering where you should put your entries, where you should put your stop losses, and take profit levels. Now, all a supply zone is where aggressive selling occurs. It's where the amount of sellers exceed the amount of buyers. For example, here, when price comes into the supply zone, we see sellers step in and bring the price down here, here, and here. And for a demand zone, it's where aggressive buying occurs. It's where buyers exceed the amount of sellers. As we can see here, when price comes into this demand zone, here, here, and here, buyers step in and aggressively bring price back up. Now, smart money likes to trade supply and demand zones. Smart money consists of institutional investors, banks, wells, and market makers, aka the professionals. Institutions are known to use the higher time frames like the daily, weekly, and monthly. We want to use the supply and demand zones to identify where the smart money is buying or selling and join them. They are the ones making money hand over fist. The goal is to identify where the big money is getting into the market so we can trade with them. The majority of the time, you're going to want to buy dips into the demand zones, and you're going to want to sell pumps into the supply zones. We have these candles that represent traders' hopes, fears, and greed coming into these charts. When market maker pushes price aggressively to the downside, average Joe starts shorting and selling, but it gets to a point that he can't sell anymore because meanwhile, Mr. Market Maker has been absorbing all those sells, and he's buying and buying and buying. Then he eventually brings price back up again. The goal is to understand the behavior of the market and where the price is going. Now we can do this because smart money leaves footprints in the charts. When there's big price action on the charts like here, this is not retail money. This candle here represents millions and millions of dollars coming into the market. This is a one-day candle, aka footprints being left behind by a market maker. Now we're going to go over identifying supply and demand zones. Here we have an example of a supply zone. Every zone has a base. Bases are formed from 50% candlesticks, which is where the move from the open to the close of the candlestick is less than 50%. Now you should already be very familiar with candlesticks because lesson 1 in this course was literally all about candlesticks. Now back to the supply zone. Every zone also has two lines: the distal, which is placed away from the current price, and the proximal, which is placed near the current price. For supply zone, the top of its zone is called the distal line, and the bottom of its zone is called the proximal line. We can see here our distal line is placed furthest away from where our 50% candlesticks close. As in this example, it's literally almost at the wick. We can also see our proximal line is placed closer to where the 50% candlesticks open and closed. So it's pretty much placed right there in the middle. Now our distal and proximal line together make our base. Imbalanced candlesticks come after the bases of our zones. For supply zone, it's where we have these big sell-offs to the downside away from our supply zones. Imbalanced candlesticks are very dominant in the direction they're moving. They show us that there are a lot of buyers or sellers stepping into the market. For the supply zone, we see a big red daily candle, meaning there's a lot of sellers coming into the market, showing a lot of imbalance. For confirmation of our imbalanced candle, its body should be at least twice the length of our base. As we can see here, our imbalanced candle is more than twice the length of our base. And the reason we want to do that is because we want to confirm if it is a valid supply zone. Valid as in it's good to trade. And the way we confirm if it's valid is by checking to see if the imbalance or the move was strong enough. And that again is by confirming that the body of the candle is larger than more than twice the size of the base. Once we have identified our base and imbalance candles, we can label our supply zone. And if we were to label our supply zone, it will look like this. You can see we have our zone, and then literally right after following it, we have our huge imbalance candle. Now here we have an example of a demand zone. We know every zone has a base, and bases are formed from 50% candlesticks. We see we have our 50% candlesticks right here. Now for a demand zone, the top of its zone is called the proximal line, and the bottom of its zone is called the distal line. Its imbalance candlestick is right here. For demand zones, it's where we have these big rallies to the upside away from our demand zone for our imbalance candle. We see our imbalance candlestick is at least twice the length of our base. This confirms the demand zone is valid and tradable. Also, I want to make a note. You notice this time for our demand zone, the distal line is at the bottom versus with our supply zone, it was at the top. And again, that's because the distal line is always going to be furthest away from price. In a demand zone, furthest away from price is always going to be at the bottom. And in a supply zone, furthest away from price is always going to be at the top. Same thing with the proximal line. Proximal line is always closest to current price, and that's why it's on top this time. All right, now that we have identified our base and imbalance candle, we can label our demand zone. And if we labeled it, it will look like this. We can see that we have our zone and we have our imbalance candle coming out of the zone showing a lot of imbalance. All right, now I'm going to cover drawing supply and demand zones. First thing we need to do is find our zones and qualify them to be good tradable zones. In order for a zone to be considered a good tradable zone, it needs to meet a few qualifications. Now for our supply zone qualifications, we have 3 requirements. And we only need to meet 2 of these 3 qualifications in order to qualify the supply zone. The first is going to be it needs to have an imbalance candlestick that is more than twice the size of the zone's body. Second, we want to have it break an upward momentum trend line. And third, we want it to take out a previous demand zone that is on the 1-hour time frame or higher. The reason we want to use higher time frames for zones is because it helps us follow the main trend, trading with the trend rather than against it, which is smarter and is going to give us a higher win rate. Whereas if we use zones on the smaller time frames, they're going to be considered weaker and less accurate. Now for our demand zone qualifications, we also need to meet 2 out of 3 of these to qualify it. The first is also going to be it needs to have an imbalanced candlestick that is more than twice the size of the zone's body. Second, we want it to break a downward momentum trend line. And third, we want it to take out a previous supply zone on the 1-hour time frame or higher. Also, something to note is that if zones do not qualify under these qualifications as good tradable zones, they should not be ignored. They just should not be traded because, again, it's going to be hard to predict price action with accuracy. After qualifying our zones, we want to focus on being as accurate and conservative as we can when it comes to drawing our zones, because it will help us with giving us the best trade setups. There's 3 methods. We have the conservative method, the less conservative method, and the accuracy method. This is an example of the conservative method for a supply zone. Of the 3 methods, it is the one I prefer. For this method, the distal line is placed at the very highest point of our base, which is this wick here, and the proximal line is placed near the lowest body in the base. Because we have a lot of 50% candlesticks here, and this is a large zone on the 1-day time frame, I'm going to put the proximal line where the majority of the candles bottoms are at for our 50% candlesticks. As you see here, here, here. The proximal line is at the bottom of the candles bodies and not the wicks. I prefer this method because I found it gives me the best range for identifying entries and take profit areas. I will cover this more detail later in this video when I cover trade setups. For now, we're going to focus on drawing zones. And this is what it will look like with the conservative method. Again, according to the conservative method, we would have this proximal line right here at the bottom of these candles. but because we have a larger base with a lot of 50% candlesticks on a 1-day time frame, I have placed them here near the pretty much average where the bottom of the 50% candlesticks are. Here we have an example of the less conservative method for supply zone. The distal line is placed at the very highest point of our base, and the proximal line is placed at the lowest point of our base. With this method, we're focusing on the highest and lowest point of the wicks that are part of the base. I personally avoid this approach because it increases our risk, because it increases the overall range of our stop losses for our trade setups. Again, I will cover this more in detail later in this video. But notice how much bigger the base is. And this is what the less conservative method would look like. And for the less conservative method, notice now how big our zone is. For the third method, we have the accuracy method. It is where the distal line is placed at the highest point of our base, and the proximal line is placed at the highest body of our 50% candlesticks. As you see here, the distal line is at this wick, and the proximal line is at our highest body for our 50% candles. I tend to not use this method because it decreases the range for entries and take profit areas for trade setups. Notice how much smaller this base is. And this is what the less conservative method would look like. Again, for the accuracy method, now notice how small our zone is. Now we're going to go over the 3 methods for drawing demand zones. For the conservative method, the distal line is placed at the very lowest point of the base, which is this wick here because it's the lowest point, and the proximal line is placed near the highest candle body in our base, which between these two 50% candlesticks is going to be right here. And if we drew out this demand zone, it would look like this. Alright, next we're going to go over the less conservative method. For the less conservative method, the distal line is placed at the very lowest point of the base, which is this wick here because it's the lowest point, and the proximal line is placed at the highest place of our base, which is going to be at this wick. And if we drew this demand zone out, it will look like this. Notice with the less conservative method that the zone is a bit bigger. Alright, now we're going to go over the accuracy method. For the accuracy method, the distal line is placed at the very lowest point of the base, which is this wick because it's the lowest point, and the proximal line is placed near the lowest candle body of our base, which is going to be right here for this 50% candlestick. And if we drew out this demand zone, it would look like this. Notice for the accuracy method how narrow the zone is. Alright, now that you understand qualifying zones and the 3 drawing methods, we can go over identifying and drawing some examples for some trade setups now. First thing we want to do is make sure we're on a higher time frame. We're on the daily, so that is good. Next, we want to look at recent price action in the charts and see if we can identify any large imbalances. We see a large dominant imbalanced candlestick right here. This is the previous example I covered, so we already know that it qualifies to be a good tradable zone. But I want to go over qualification 3, which is, does this imbalanced candlestick take out a previous demand zone? Earlier in the video I mentioned to cover this, so we're going to go over it. Now, the last time prices were around 40.1K to 43.7K was a while ago. And if we zoom out, we can see this. So I'm in the daily, zooming out. If we can see this time period was around the middle of December, and if we go all the way back, the last time prices were near this level was back in April of 2022. So literally almost 2 years ago. It's been a while. Alright, and I'm going to zoom into this area over here. Alright, now I want you to pause this video and give yourself about 30 seconds to identify our potential imbalanced candlesticks for the previous demand zones we're looking for. Remember that there needs to be 50% candlesticks that come before the imbalanced candle, and the strength of the move of the imbalanced candle needs to be strong enough to where it potentially is twice the size of the base. Alright, now pause this video and try to find those imbalanced candles. Alright, we can see we have an imbalanced candle here, here, and a smaller one here. Now I'm going to draw out our demand zones. So I'm going to click this rectangle tool. For our first demand zone, I'm going to use the conservative method. So distal line is placed at the bottom of the base, which is wick, and the proximal is placed at the top of the 50% candle, the base, which is right there. All right, so we know that for our imbalance candle for our supply zone that we're trying to see if it takes out one of these previous demand zones, we know that it starts right up about here at 43.7K, and the wick goes down to about 40.1K. So I can already tell just by lining this up that it's not going to take out this demand zone. So we can already exclude this one. Now I'm going to draw our demand zone for our second imbalance candle. I'm going to use the conservative method as well. So you got the bottom of the base, which is the wick, and then top of the candle. And we can see this one is also just shy of about 40.1K. So this one's not going to work either. All right, guys, now I'm going to draw out this third demand zone using the conservative method once again. All right. And we can see that this demand zone is in fact above that 40.1K area where our imbalance candle for our supply zone wicks to. And also to confirm this imbalance candlestick, we can see that it does in fact break a downward momentum line, and also it is about twice the size of our base. So now what I'm going to do is bring this demand zone all the way over to our supply zone area that we're trying to see if it takes out this demand zone. Now also keep in mind, as I mentioned earlier, normally this would take a lot less time, but because prices haven't been near the current price levels of this imbalance candle, we've had to go all the way back to about a couple years ago. All right. I would say it does not take out this previous demand zone because the imbalance candle does not close beyond the demand zone. Only the wick of the imbalance candle pierces through the demand zone. But it's okay if this is not the case because we know that our imbalance candle does break this upward momentum trend line, and also that the imbalance candle is very dominant and more than twice the size of the base. So for that reason, it still meets 2 out of those 3 qualifications. So the supply zone is valid and tradable. All right, now that we have our supply zone drawn, we need a demand zone in order to start creating some trade setups. So we're going to let price action play out now. All right, so at this point in time, we can see that we have strong buyers that have stepped into the market. We can see from these wicks here, here, and here. Remember, these are on the daily time frame, so these are very aggressive buys where the buyers have stepped in and aggressively brought price back up. Now we have an imbalance candle here, but there's a big issue. It is not a dominant imbalance candle. It's literally a 50% candlestick in itself, which is not what we want for our imbalance candlestick. Of the 3 requirements, one being, is the imbalance candlestick twice the size of the body? And then 2, do we invalidate a downward or upward momentum trend line? And then 3, does it take out a previous zone? Of those 3 qualifications, I think that the most important one is how dominant the imbalance candlestick is. So that's why I want to put an emphasis on this. Now we want a dominant candlestick where the body makes up the majority of the imbalance candle, like this. Where this candle, literally its whole entire body makes up about 95% of the candle, and it's like only 5% wicks. Or this candle, similar. Or even this candle, its body's about 80% of the candle, and then the remaining 20% are the wicks on both ends. Or this candle, or this candle. These are all examples of very dominant candles. This is what we want for imbalance candles. What we don't want are 50% candlesticks. Like any of these candles, like this candle, like all of these candles. That's absolutely what we do not want for our imbalance candlestick. So since this imbalance candle is not dominant enough to qualify for a tradable zone, We're going to go on a lower time frame to see if we can clearly see a dominant imbalanced candlestick that precedes 50% candlesticks. So I'm going to go down to the 4-hour time frame. All right, we see we have a dominant imbalanced candle with 50% candles right before it. We also see it breaks a downward momentum trend line. And for our third qualification, we're going to see if it breaks a previous supply zone. We're going to stay on the 4-hour time frame and see if it takes out any of the recent supply zones. All right, I think I see a supply zone here. It should be more clear on the 2-hour time frame. So I'm going to go to the 2-hour time frame, bring that up. And yeah, we can clearly see that we have an imbalanced candle that is twice the length of the base. So I'm going to label that with the conservative method. And this is a supply level. Another thing I forgot to note earlier in this video is that when I create my demand or supply zones, I label them under the time frame that they were created from. So this one, for example, that we're testing out to see if it is broken is on the 2-hour. This one earlier was created on the 1 day, so I'm going to go ahead and label that. And the reason we do this is because typically the higher the time frame that the level or zone is created on, it's going to be stronger and it's going to be able to provide more accuracy and the higher the time frame is for future trade setups. So that's very important to note. All right, now if we go back to our 4-hour time frame, we can see that our imbalanced candle does not break this 2-hour supply level. However, most traders include the additional 1 or 2 candlesticks that follow the move of the imbalanced candle when determining if an imbalanced candle takes out a previous zone, especially if they're dominant candles. Because the second candle is so dominant, I'm going to say it clearly takes out this supply zone. Another important thing to note, guys, is that the way I'm teaching you about qualifying the imbalanced candle without having to rely on the candles that follow it, it's a conservative approach to focusing on bigger trends and moves in the market so we can be more accurate. If you see other YouTubers mentioning using 2 to 5 candles to determine the strength of the imbalance, that's just a different approach and is very common when it comes to using smaller time frames like the 5-minute to 30-minute time frames. Remember, the goal here is to catch the big moves where the easier gains can be made and the larger gains. We're not trying to catch all these small moves on all these small time frames. This is why, again, I prefer using the higher time frames and making the one single imbalanced candle the focus of our zones. There's going to be exceptions though, like this example I showed you, but there are plenty of times where we can solely rely on having one single imbalanced candle for some great trade setups. Alright, so we see for this demand zone that it does take out the 2-hour supply zone, so I'm going to delete that. And now since we have our confirmations, I'm going to label and draw out our demand zone using the conservative method. And this is a demand zone. And also I'm going to label it as the 4-hour because that's the time frame it was created under. All right, we have that. Now I'm going to go to my 1-day time frame. All right, now notice how this demand zone appears to be out of place on the 1-day time frame. This is okay though because we did our job for validating the demand zone on the 4-hour time frame. I'm going to be using the 1-day time frame for our trade setups because of how powerful the imbalanced candle was for this 1-day supply zone. All right, now that we have our supply and demand zone, we can go over trade setups for this example. First, I want to go over what is the best trading strategy. Okay, guys, there is no such thing as the best trading strategy out there when it comes to trading. It's all subjective. There's no one-size-fits-all trading strategy. Some traders prefer quick trades in the market, like scalping, especially if they're eager and like fast results, while other traders prefer the slow and steady approach of swing trading, maybe waiting weeks for the perfect trade. It all comes down to you as an individual and which strategies best complement you. For example, if you're all about details and quick decisions, scalping could be your thing. If you're more patient, swing trading could suit you better. The main point is Trading strategies are personal. Find what you're good at and what fits you best. Since we're looking at supply and demand zones on longer time frames, I would say day trading and swing trading are going to be more effective because it can take days or even weeks for these zones to show results. All right, now we're going to go over some trade setups. First thing we want to do is identify which direction is the market going on the higher time frames. If the market is trending down, then we would want to trade the continuation of the trend. So we would sell into supply and buy back into our demand zone. If the market is trending up, then we still want to trade the continuation of the trend. We would buy into a demand zone and then sell into a supply zone. And if the market is ranging or trading sideways, we might want to consider trading the range or waiting for a better setup. The overall idea of this is we do not want to counter trade or trade against the larger trend, especially if you're a beginner trader. This is something very difficult and I'd only suggest for an advanced trader to try to do. Now to identify which direction the market is moving, we're going to start with our higher time frames. We're already on the daily, so that is good. I'm going to zoom out here. All right, so this looks good. We can see the trend is clearly going up. We're creating higher highs and higher lows. So we create a high here, a low here, higher high here, a low here, and then we maintain structure and for a little bit, and then we continue creating higher highs and higher lows. Now, if I was to take this drawing tool and we go back a year to see what's happened in price. So this is December 23, we go to December of 2022. I measure the gains made from the lows here to the highs over here. You can see Bitcoin has risen 176% in 1 year. What other asset can do that? There's no comparison. I'm not even going to go there. So we can see that Bitcoin is clearly in a bull market. And in bull markets, the majority of the time, we're going to want to buy into the dips and sell-offs. So for this trade, I'd be favoring price to pull back into our demand zone for a long setup. We're favoring a long and buying opportunities under the current market conditions. All right, now we're going to go back to our supply and demand zone. All right. Now, when it comes to a supply and demand trading strategy, the majority of traders will put their entries at the proximal line and they put their stop loss at the distal line. Additionally, for choosing where to put your stop loss in the demand zone, some traders like to put it a little lower than the previous structure low to have a little extra breathing room. This is the method I prefer depending on how good my entry is. So for example, if I take this measuring tool, if I was to get a good entry around the low of this distal line and go over here to the previous structure low, I would set my stop loss at a max of about 2%, risking 2%. This would be in a great scenario. Now, in a bad scenario, let's say I get in, or not bad, but let's just say a worse scenario, I get in around the proximal line over here. And if I was to go over here and put my stop loss near the same area we just looked at, I'd be looking at around like a 3% loss, which is risking too much in my opinion. So around 2% is still right there near the previous structure low, so that'd be good. Now for taking profits, the majority of traders will choose the opposing zone. For example, if we're buying from this demand zone, we would set our target to sell or take profit at the supply zone. Vice versa, if we're selling from the supply zone, we would set our target to take profit and buy back at our demand zone. Additionally, for taking profits, the risk to reward ratio traders are aiming for can affect where they put their stop loss and take profit targets at. For example, let's say we got an entry over here and we're risking about 2%, so our stop loss would be here. We would want to achieve a 2% gain in order to meet our goal of having a 1-to-1 risk to reward setup. Let's say we have a setup of 2-to-1, so we're risking 2% to get a 4% trade. That would put our take profit target right around here. Notice how it's still not in the opposing supply zone. Now let's see a 3-to-1 setup. So we're risking 2% to hopefully get a 6% gain. So even if this trade played out and we put our take profit target here and that take profit target was hit, notice it's still not in the opposing supply zone. So in some scenarios, traders are not even aiming to reach the opposing supply zone. They're just aiming to get the right entry at the demand zone. Now, when it comes to risk to reward targets or setups, I like to aim for 1 or 2 R multiples. So 1-to-1 or 2-to-1 risk to reward setups. The lower your risk to reward setup, the higher your win percentage needs to be. Me personally, my win percentage ranges from about 55 to 70%. So that's very good. As a beginner trader, yours is most likely going to be around 20 to 35%. So you need to aim for higher risk reward setups, like 2-to-1 and 3-to-1 and up. Now we're going to let price play out and look for some trades. Keep in mind, we're looking for buying opportunities because the market is trending up. So we want to see if price comes back into our demand zone and creates any buying opportunities for us. Also, because we're now looking for entries, we're going to focus and monitor price on the lower time frames. I'm also going to match this up. All right, so let's go to our 4-hour time frame, and we're going to let price play out. All right, so market is ranging. All right, market is still ranging. Okay, so right here, we had a bit of an imbalance. You know, we had a pretty much, I'm going to label this a supply zone has been created. So I'm going to label that. And this is on the 4-hour time frame. Okay. All right. So let's let price keep playing out. So we're expecting that supply zone. Price is still ranging. Okay, all right. Now we have come into our demand zone. I'll make this a little bit bigger. All right. Now we're looking for an entry. It's not as simple as, hey, price is at our proximal line, so let's enter. You also want to take into account liquidity. You know, we're looking for, are there any traders currently underwater in their trades and at risk of being liquidated at the current price or near current price levels? And the reason we want to focus on that is because market makers and big players see these pools of liquidity, push price to those pools, grab the liquidity, and bring price right back in the opposite direction. It's a way that they can deploy a massive amount of capital all at once. Also, other things you want to consider is, you know, what does the volume look like? Are we at major support levels? What do the technicals look like? These are all things we can use to our advantage to determine if price is likely to hold and reverse from this point in time for this demand zone, and if Bitcoin will continue moving up. Now, all these things don't create certainty or 100% predictable moves, but they definitely provide an edge when combined with our zones to be used as confirmations for trade setups. Now, you've probably noticed how long this video is. It's to break down supply and demand. I'm not going to go over these topics. There will be lessons in this course that go in detail over these topics though. So let's say, based at where price is right now, and along with more confirmations from these other tools and resources, that we've decided that we want to get in right here. Now's the time to buy. So we're going to set our stop loss. Let's say we set it 2% below our previous structure low. And because there is an additional supply zone now in the 4-hour, we've decided, hey, we want to set 2 take profit areas. The first take profit area is going to be 50% of our position at this 4-hour supply zone, and the remaining 50% of our position is going to be at 1 day for the second take profit target. And now we're going to let price play out. So right here we see that our demand zone is broken briefly on the 4-hour time frame, but price is still holding. All right, and here we see that our first take profit area has been triggered, and also the 4-hour candle has been closed above the 4-hour supply zone, meaning it's been invalidated now. And so price starts to range. All right, so now our second take profit target area has been hit. Now we're going to remove this 4-hour supply zone because it has been invalidated by having a dominant imbalance candle take it out. This imbalance candle is on the 4-hour time frame for demand zone, so we're also going to draw that out. And I'm also going to label this as a 4-hour time frame. All right. So we see that our imbalance candle breaks a downward momentum trend line, and we see that the imbalance candle is more than twice the size of the base. Now we have another imbalance candle right here, and we can see it does not meet that first qualification of taking out a downward momentum trend line. For a second qualification, we can see that the candle is more than twice the size than its base. So we have 1 out of 2, and for our last qualification, does it take out a previous supply zone? So here we see we have a supply zone right here. And we can see that this candle clearly takes it out. And for that reason, I'm going to go ahead and draw it out as well. This is a demand level on the 4-hour. All right. Something very important to know, guys. When I have created my zones on the higher time frames and the price is ranging within those 2 zones like it is now, and then as it's ranging, we have all these new zones being created in the middle of the range, I would not be using them to open entries or take trades at. I would only be using them for take profit targets as I demonstrated in trade setup 1. My entries for trade setups would remain only to be taken at the large zones. All right, now we're looking for trade setup 2. So we're going to go back to the 1-day time frame. Now we can see that sellers are still strong in the supply zone on this 1-day candle. They have pushed price down. That's why we have this wick. Some traders will be looking for a trade setup where they can short this or sell at the supply zone here, and they'd put their take profit target near our demand zone down here. But we know that we're in a bull market and the market is trending upwards and we're only looking for buys, so I'm not going to do that. We're going to go back here to the 4-hour time frame, let price play out, and see if we can get an entry for a buy at our demand zone over here. All right, so price is ranging, still ranging. All right, so now we're starting to get some consolidation. There's a lot of wicks at the bottom and top of this range. Still consolidating. All right, so sellers have stepped in. So from sellers stepping in there a little aggressively, they created this imbalance candle. The candle is more than twice the size of its base. However, it does not break an upward momentum trend line, and also it does not take out this previous 4-hour demand zone that's right at the bottom of its wick. So it's not tradable and we can't draw it. We'll let price continue to play out. All right, sellers step in again. All right, so at this point, we have another imbalanced candlestick created from aggressive sellers. The candle is more than twice the size of its base, and this time it does break this upward momentum trend line, and the candle itself does not take out the 4-hour demand zone, but it has a few additional candles that follow it that also add to its selling pressure and that close beneath it. So we're going to say it takes it out. It didn't have to do that because of the previous two qualifications though. So remove that. And this 4-hour demand zone is currently holding up. We're going to let price continue to play out. Still waiting to see if price gets to our lower demand zone for a buy entry. Oh, I forgot to label that supply zone right here. This is going to be on the 4-hour. All right, let's let price play out. All right, so sellers are stepping in a little bit. All right, so sellers have stepped in again. Price is still ranging though. Still ranging. All right, so at this point in time, there's a couple things I want to point out. Notice for this range we have here where the sellers came in at. They came in here right at our 4-hour supply level. And notice where the buyers came in at. They came in here right at our 4-hour demand level. Notice how price is respecting all these zones I've drawn out. Now we also have an imbalanced candle right here. It is twice the length of its base. It doesn't take out the preceding 4-hour supply level. However, the candles that follow it are all also very dominant, so it clearly takes it out. So I'm going to delete that. And I'm going to draw this demand zone. We're going to also label it because we're still on the 4-hour time frame. It's going to be for the 4-hour. All right, now if I go to the 1-day time frame and we look at the bigger picture, we're still waiting for a trade setup. Now we can see that our candles at the top of our main supply zone. Some traders will be looking for shorts here, but we're not going to do that. Now notice how the traders I mentioned earlier that tried to short here and had their take profit targets at this demand zone, they all had losing trades and got stopped out because price did not reach it before reaching our supply zone again. All right, we're going to go back to the 4-hour and let price continue to play out. All right, so we're still looking for price to come back to our demand zone for a buying opportunity. Sellers are stepping in a bit here at the top of our supply level. All right, so they stepped in very aggressively. Now we have an imbalanced candle here. You see that it does break an upward momentum trend line. We also see that it is more than twice the size of its base. So I'm gonna draw this out. And we're still on the 4-hour time frame. All right. We can see none of our demand zones were taken out. Now remember when I mentioned I would not be executing entries and opening new trades at zones in the middle of this range? Traders that tried to catch this downward move and buy at either of these demand zones in the middle of the range here and here would have got stopped out. So for example, let's say saw this big move and they're getting excited and they wanted to buy. Let's say they try to buy at this part of the demand zone right here. Let's say if they would have been conservative and put a 2% stop loss, they would have got stopped out and lost that trade. Same thing for this demand zone. They would have set a 2% stop loss, they would have got stopped out. Our second trade setup is here at our main demand zone. Now this trade would have been very hard to get into, but if you happen to be in front of your computer and were prepared, it would have been possible to execute. With our other confirmations, we would have been able to get into a trade around these prices. Now let's go to the 1-day time frame. All right, let's say we were able to get an entry around these price levels and we set a stop loss at about 2%. We could see that our stop loss would be below our previous structure low, which is still intact. And for our take profit target, I normally would put it in the supply zone, but because how aggressive sellers recently stepped into the market, I would put it right about here, so 6.9%. All right, let's let the candles play out now. All right, so we can see that our take profit target would have been hit for trade setup 2. All right, now that we have gone over some trade setups using supply and demand zones, we're going to cover zone patterns. Now for zone patterns, we have two types. The first type is a continuation pattern. Here we have an example of a continuation pattern for a supply zone. It's called a drop, base, drop. We have a sell-off, then a base, then a drop. Notice the continuation of price dropping. We can see we have our imbalance candle here, followed by a base that is formed, and then a drop caused by another imbalance candle. For our bases in all of these zone patterns, the bases are going to be created with 50% candlesticks. The second type of pattern we have is a reversal pattern. Here we have an example of a reversal pattern for a supply zone. It's called a rally base drop. So you see we have a rally, then a base is formed, and then we have a drop. We see we have our imbalance candle here, followed by a base that is formed, and then a drop that is caused by another imbalance in the charts. Here we have an example of a reversal pattern for a demand zone. It's a drop, base, rally. For this reversal pattern, we have a sell-off, then a base is formed, then we have a rally. We see we have our imbalance candle here, followed by our base, and then a rally caused by another imbalance candle. For our last example, we have a continuation pattern for a demand zone. It's a rally, base, rally. For this continuation pattern, we have a rally, then a base is formed, and we have another rally. We see we have our imbalance candle here, followed by our base, and then a rally caused by another imbalance candle. I prioritize solid demand and supply zones because they directly indicate areas of strong buying or selling interest. This method avoids the subjectivity of interpreting patterns like a rally-based rally or drop-based rally pattern, making it easier to identify clear trading opportunities. I prefer combining solid zones while looking at where liquidity and open interest is at, along with volume, market sentiment, and other technicals. The goal of this lesson was to help you understand the idea of supply and demand and identifying and drawing zones. In the other lessons of this course, I will cover liquidity and other confirmations that we can use with great supply and demand zones for creating solid trade setups. The goal of this course is that by the end of it, you will be able to take all this information in each lesson, put it all together to give you an edge in your trading and to help you become a more successful trader. If you have not yet liked and subscribed to my channel, do so. Also, feel free to join our crypto gains community where we share market insight and trader alerts. Also, comment below for any questions and I'll be happy to answer any of them. All right, see you in the next lesson.